All right, let's dive into the world of technical analysis. Now, I know what you might be thinking. That sounds complicated, maybe a little intimidating. But don't worry. The goal here isn't to turn you into some kind of Wall Street wizard overnight. It's actually much simpler. We're going to learn a new language, the language of the market. And trust me, it's way more accessible than you think. To get our heads around this, let me ask you a question. Just imagine, you're on vacation in a city you've never been to. You're starving. You turn a corner and suddenly you're on a street packed with 100 different food stalls. You don't speak the language, everything's new. How in the world do you pick the best place to eat?
Well, you basically got two options, right? On the one hand, there's option one. You could go stall by stall, try to inspect all the ingredients, analyze their cooking techniques, and do all this deep, fundamental research to figure out which one is intrinsically the best. Or there's option two. You just stand back for a minute, look around, and go to the stall with the longest, happiest-looking line of people. You follow the crowd.
And that right there is technical analysis. It's option two. Instead of digging deep into a company's finances and balance sheets, which, by the way, is called fundamental analysis, technical analysts just watch the crowd. They analyze the collective actions of millions of buyers and sellers, all of which are perfectly visualized on a stock chart. It's really just the art of reading the room.
So here's our game plan for learning this new language. First, we'll nail down the core idea behind it all. Then, we'll learn the actual language of the charts themselves, how to read these things called candlestick patterns. From there, we'll see how you can use that knowledge to build a real trading plan. And finally, we'll zoom out and see how this all fits into the bigger picture.
So what's this all built on? I mean, it can't just be random guesswork. And it's not. Technical analysis is actually founded on a few key, really powerful assumptions about how markets actually work.
First is the belief that markets discount everything. The idea here is that all the information out there, good news, bad news, company earnings, rumors, it's all already baked into the stock's current price. And that leads right to the second point. The how is more important than the why. A technical analyst doesn't really care why a stock is going up, just that it is going up. Third, price moves in trends. An object in motion tends to stay in motion. And finally, the big one. History tends to repeat itself. Why? Because human psychology, fear, greed, excitement, doesn't really change over time.
Okay, so if we're gonna learn this language, we've got to start with the alphabet. In technical analysis, our alphabet is the chart, and the letters are these incredible little things called Japanese candlesticks. They're what turn dry price data into a vivid visual story.
You see, unlike a simple line chart that just connects the dots of closing prices, a Japanese candlestick gives us 4 key data points for any period: the open, the high, the low, and the close. Every single candle is like a mini snapshot, a little story of the battle between the buyers, who we call the bulls, and the sellers, who we call the bears.
Let's break down a bullish or green candle. See that thick part? That's called the real body. For a bullish candle, the price opened at the bottom of the body and closed at the top. It's a clear signal that the buyers won that session. And those thin lines sticking out, the shadows or wicks, they show us the absolute highest and lowest prices the stock hit during that period.
Now, a bearish or red candle tells the complete opposite story. Here, the price opened at the top of the body and closed down at the bottom. This shows us that the sellers, the bears, were in control. The shadows still show the session's high and low. So when you put them all together, these two types of candles give us this incredible visual of the market's constant tug of war. Okay, so we've got our letters. Now it's time to start forming words and even full sentences. Once you can read individual candles, you can start combining them into patterns. And these patterns, well, they tell us much more complex stories about what the market is feeling.
Let's kick things off with a classic bullish pattern. This one is called the bullish engulfing, and you'll see why in a second. It's a really powerful 2-day signal that the trend might be about to reverse.
So here's the story it tells. Picture this. A stock has been in a downtrend, just falling and falling. On day 1, you see a red candle. Sellers are clearly still in charge. But then, on day 2, something dramatic happens. A huge green candle opens even lower, but then buyers just rush in with so much force that it not only recovers, it closes above where the previous day even started. It completely engulfs that prior red candle. The meaning is crystal clear. The buyers have just staged a massive, powerful takeover. Okay, so that was the bulls. Now let's look at a bearish pattern that signals the exact opposite. This one's called the shooting star, and it often shows up right at the top of an uptrend. The story here is all about exhaustion. So the market's been trending up, everything looks great. On this particular day, the buyers try to keep the party going. They push the price way, way higher, creating that long upper shadow, but they can't hold it. The sellers step in and just slam the price all the way back down, leaving just a tiny little body at the bottom. It literally looks like a star falling from the sky. This tells us the buyers are probably running out of gas and the sellers are starting to take control.
So recognizing these patterns is one thing, but how do you actually use them? I mean, how do you go from seeing a pattern to making a decision? That's where a trading plan comes in. It's all about taking these signals and building a disciplined, repeatable strategy around them.
Two of the most important tools for building that plan are support and resistance. Just think of support as a price floor. It's a level where, in the past, buyers have consistently stepped in and stopped the price from falling any further. And resistance? Well, that's the ceiling. It's a price level where sellers tend to show up in force and stop the price from going higher. Knowing where these zones are helps you figure out where to get in and where to get out.
Another absolutely crucial piece of the puzzle is volume. That's just the number of shares being traded. Think of volume as conviction. A big price move on high volume is like someone shouting. A move on low volume is just a whisper. So if a price is rising and volume is also rising, that's a strong confirmation. But a rising price on low volume? That's a huge red flag. It suggests the move is weak and could fail at any moment.
So, a basic trading plan brings all of this together into a simple checklist. First, you identify a promising pattern. Then, you make sure it fits with the overall trend. You look for a surge in volume to confirm that there's real conviction behind the move. You identify your key support and resistance levels. And this last step, honestly, it's the most important one. You define your exact entry point, your profit target, and your stop loss before you even think about placing the trade. That stop loss is just an automatic order that gets you out if the trade goes against you. It's your safety net. This whole process takes the emotion out of it and gives you a disciplined approach.
And finally, let's zoom all the way out. Because while these patterns and plans are incredibly useful, it's really important to understand the context they appear in. They don't just happen in a vacuum. They're part of much larger market cycles. You can almost think of them as market seasons.
According to a classic idea called Dow theory, a major market trend has three main phases. It starts with accumulation. This is when all the news is terrible, nobody wants to own stocks, and sentiment is in the gutter. This is where the informed investors, the smart money, quietly start buying. Then comes the markup phase. Things are looking better, the trend is now obvious, and the general public starts to get excited and jump on board. And finally, you get distribution. This is the peak. There's euphoria everywhere, you hear stories of people getting rich quick, and that smart money that bought way back in the accumulation phase is now quietly selling their shares to that overly enthusiastic public.
And this really brings us to the most important point. Please don't get bogged down trying to memorize hundreds of different patterns. Like this quote says, the real goal is to learn a new way of thinking about the markets. It's about understanding the psychology behind the patterns, seeing the story of human fear and greed playing out right there on the chart.
Learning to read charts is really like learning any new language. It just gives you a brand new way to see and understand the financial world. You now have the basic alphabet and the grammar. So the only question left is, what stories will the market tell you?